There was a fair bit of drama in the options market on Friday. I'll tell you what happened very quickly. So, there was an instance where a trader punched in a market order for buying the 67,000 call option, the Sensex call option. This has happened on Friday, the expiry day. Now, the premium for this was quoting at between 4 and 5 rupees. The trader punched in a market order. The order got executed all the way up till 209 rupees. So from 4 or 5 rupees, the premium went up to about 209 odd rupees or so. So the order fill happened starting from that where the current market premium was all the way till about 209 odd rupees or so. As a result of which, and this is all from social media, X. So the trader sort of put out a post saying that he suffered a loss of 78 lakhs and he's kind of disputing this trade with the broker. So just a kind of introduction to what really happened. And this has kind of been debated a fair bit, especially on social media since last Friday. We have Rajesh Baheti, Managing Director at Crosseas Capital Services, joining us now. Tejas Khoday, the co-founder and CEO of FYERS. FYERS is the broker where this trade got executed, is also with us. Gentlemen, good morning. Good to have both of you here. Tejas, so you're at the receiving end of a fair bit of criticism, I dare say, on social media. Tell us, is this what happened? Were there any failures, system failures on your part or exchange part, which allowed this to happen? Go on.
Hi, Prashant. Firstly, thanks for having me here. There were absolutely no system failures at FYERS or the exchange. Basically, the customer has placed stop-loss market orders instead of placing stop-loss limit orders in the 67,000 call option that expired on Friday. There is really no issue here, as false claims have been raised against us. And I want to clarify another thing right off the bat, that it was not a fat finger trade either, because the client had placed more than 300 orders to execute that trade, which doesn't qualify as a fat finger trade by definition.
Okay. By the way, has the trader reached out to you guys officially, disputing what has happened?
Well, he hadn't really reached out to us. In fact, we reached out to him and tried to educate the customer about, his error, and seems to be very defiant.
So, Tejas, hi, morning. I just want to understand this a little better. On this instant particularly, will the trader get a refund, or is the trade now settled?
The trade is settled. And it doesn't work like that, Sonia. If all traders start to demand their losses incurred in the markets due to their own fault, the business does not work like that. We are intermediaries. We are not counterparties to the trade. This trade also has counterparties who have benefited from the trade. So it cannot be null.
Okay.
Rajesh?
Yeah. Rajesh, I just want to come to you on this just to understand, in general, how do you see, what is the big learning from this instant? And do you think BSE should now disallow these SLM orders, SLM trades?
So a couple of things I've been thinking over the weekend about this problem. Option prices don't move in a linear manner like the underlying does, because of the fact that the delta keeps changing, and option prices can actually go from, say, 4 rupees to 200 or even 2,000 rupees in a day if the underlying changes. So putting artificial limits on option prices is always going to be a problem, because that will prevent proper trading in the market. Having said that, a couple of things can be put in place. One is that stop-loss orders should not be allowed as a market order. So clearly, we've heard FYERS today say that these stop-loss orders were getting executed at market prices, and if the liquidity then thins out after a certain number, then that order will go and clean out the entire book. So maybe one of the changes that could be done is that the stop-loss orders should not be allowed as a market order, but should be a limit order, just as in all algos, we are not allowed to place any market orders. All orders have to be limit orders. The second thing is, if you look at the option theory, you will know that an option can be priced independently, but at any time it should trade somewhere between the previous strike price and the next strike price. Maybe a trade annulment policy where an option trades outside of the bounds of the next strike price and the previous strike price. So previous strike price on the low side and next strike price on the high side, subject to certain maybe 5-10 rupees here or there. If you can have a trade annulment policy, because that clearly would indicate that it's an error, because logically speaking, a 67,000 option should only trade between the 66,900 option and the 67,100 option price. It cannot logically trade above, out of bounds of those two prices. So maybe a trade annulment policy that prevents such kind of happenings can be thought about by the exchanges.
Tejas, the NSE doesn't allow stop-loss market orders, right?
Yeah,
The
it doesn't
BSE does.
allow it. Yes, so they also did allow up until September of 2021. And because a few free trades had happened on NSE, they decided to come out with a pre-trade risk control framework. And the first move that they made was to disallow stop-loss market orders. They've done a series of things to prevent such incidents from occurring. And you see, the thing is with BSE, it's the F&O segment is new. And liquidity has just coming in the BSE F&O segment. And it's about time. I bet they are working on it as we speak.
Are you in touch with the BSE? So will we see a change from their end?
Yes, we are in touch with BSE. We are required to report this trade to the surveillance department. And I'm very sure that they are working on it.
Rajesh, so if this, some of the changes you suggested, of course, I mean, will address future problems as well. But a straightforward thing is to disallow stop-loss market orders, like how the NSE is done. And as Tejas pointed out, I mean, the F&O segment in Sensex, it's picking up in a very, very big way, but it's still relatively new. So would that have taken care of this particular problem, which we saw on Friday?
Yeah, it would have taken care of the problem for that single piece of order that, you know, if it's a large order and it goes at market, it can clean out the book. But as the gentleman just said, that there was a series of 300 orders. And what seems to have happened here is that successive stop-loss orders have triggered off the other stop-loss orders resting in his system and has created a chain effect. So my second suggestion, that the option should not be allowed to trade, actually execute a trade outside of the bounds of the previous strike price and the next strike price, might even prevent this successive stop-loss trigger effect that happens in the market sometimes.
Okay. Tejas, is that your view as well, that there should be at least a nudge, from the BSE that options are illiquid, traders should be careful while trading, something of that sort?
Well, we as brokers are required to publish a risk disclosure, which clearly mentions that approximately 89% of F&O traders lost money for the duration that it was tested for. So the risk disclosures are already there, and the client in question, is not a first-time options trader. He's been there, done that. This seems to have been an error from his side. And anybody who enters the futures and options market should be well aware of the risks before delving in my opinion.
Absolutely. I can't say that enough number of times. Thank you very much, both of you gentlemen, for joining us. Quick chat this morning on this issue, which is, I think, taken up a fair bit of, at least attention on social media and otherwise. Tejas and Rajesh, good to speak with both of you here. Anuj is now